System that just ain't right. Gonna tear it down. Gonna start a fight. Anarchy and numbers is my game. I'm the investor with no shame. Greed and corruption, that's the name of the game they play. It's all a shame. I won't play by their rules. I won't comply. Anarchy's the way. It's time to fly. I'll burn down the walls and here we go. Welcome. I am Matt. This is the Anarchist Investor live, coming at you every Monday through Friday at 12 Eastern. Talking about contrarian investment, markets, the economy, how to protect and grow your money without getting it stolen by some dirty banksters and the government, because that's what we're talking about today. A reminder, help me out with the algo. Give me a thumbs up. Give me a like, a follow, a subscribe. Share this out there, and do me a favor during the program. Comment. I'm here live. Let's have a conversation. I want to hear your opinions on what I'm looking at and what you're seeing from your end as far as investment or the economy goes. Let's have a conversation, because that's the way that we all kind of figure out things together, which is absolutely fantastic. And another reminder, make sure to sub to the Anarchist Investor on Substack. It is anarchistinvestor.substack.com. You will get in on this month's free drawing for 4 one-year paid memberships to the newsletter. Super awesome things that you get for free, including access to the model portfolio. So without further ado, let me pull the banner off the screen and show you what we had on the hold screen. On the hold screen, we have government spending. Ugh. We're going to get to this. I'm going to dig into this a little bit deeper. But if you notice, there's a ton going on here. There's not very much consistency to it. There's a ramp and then a fall off and then another ramp and then an even bigger ramp. We're going to talk about why right now. The reason why I said why twice, but there's a lot of why going on here. All of the pundits, whether they be political pundits or, like news media pundits or investment media pundits, are all talking about the resilient and the strong economy. We have such a resilient economy. It's doing so well. The consumer is doing incredibly in the face of astronomical odds and all this stuff that's coming down on them. Consumers doing so well, right? It's bull. Wait for it. Shit. The whole story, the whole narrative is complete gaslighting. Complete gaslighting. It is absolutely ridiculous. Okay. John's telling me, and obviously this is a scam, so please don't click on it, but just received $13,794 at the MicroStrategy giveaway event. Congratulations. If you can get any money out of MicroStrategy, that's fantastic. Let me pull up the actual MicroStrategy chart here, and we'll see what a great investment MicroStrategy is. Okay. Ramp, fall off, and this fall off isn't done yet, just by the way. It might even ramp a little bit again with Bitcoin gaining a little bit of steam here, but eventually this thing is going to go the way of Bitcoin, which I believe is not up to $1 million a coin. So anyway, that being said, this has GameStop and AMC written all over it. But so anyway, back to the original title of this actual program. Government spending is basically the entirety of what people are trying to gaslight you into thinking is a strong economy. In fact, it's all debt spending. It's all grabbing demand from the future and screwing you and your kids and your grandkids out of good economic growth in the future to try and drag it into the present to make things look better than it really is. And I'm going to show you exactly what I'm talking about. Okay, let's look here first at the consumer price index has obviously been going up. So everyone's been saying, oh, it's inflation, it's inflation, right? This is basically money printing and all this other stuff. No, it's actually, we're headed in the opposite direction. This is actually the back end of a supply disruption. And I will show you what I mean. Okay. Corporate profits we'll actually talk about probably in a later episode this week. but you're already starting to see cracks in corporate profitability as well, despite the quote unquote amazing the amazing economy that we have right now. All right. So the first thing I'm going to look at is GDP. So anyone who's not familiar with GDP is gross domestic product, okay? And it's basically a measure of the productivity of the economy, all right? This is US GDP. All right, and I'm going to show you a couple of things here. Look, when I zoom out here, okay, and this is basically, if I can throw this onto a log chart, I think it looks maybe a little bit better. It's about the same. All right. So you see let's call it 2000, okay? There's a certain growth path here of the US economy in terms of its GDP, all right? Looks fairly strong. And again, this is a logarithmic chart, so it's not like straight up and to the right. In fact, it's actually kind of curved higher, okay? The US was growing at a pretty decent clip throughout the 90s into the early 2000s. Again, fueled by this kind of progressively lower and lower and lower interest rate environment that we find ourselves in. Something materially changes in 2000. And in 2000, if you remember, it's dot-com bubble bursts, right? And you have this big recession, 01, 02. And eventually what happens is, as a result of that, you start to see greater and greater Federal Reserve interventions within the system. You also see greater and greater federal government interventions within the system, okay, within the financial system. That being said, and I gotta, in the comments, I gotta make sure that John here is taken care of with his Ponzi scheme. Again, do not click on John's link. But you see greater and greater interventions on the part of the Federal Reserve and the US government into financial systems. All right. So starting in 2000, look, between the yellow line, which is essentially the trajectory, and again, this is kind of like smallish to see, but it's actually in real terms, it's huge numbers. Okay. You're talking, $500 billion at a time here, and each one of these successive data points, you have this growth trajectory that then drops down. Okay. And this quote unquote recovery from the dot-com bubble bursting is no longer on that growth trajectory. Okay. So now we've just stepped back the growth trajectory of the US economy. All right. Now, it's not necessarily immediately felt by everyone. That step back in the growth trajectory of the US economy is felt by people who are new entrants into the economy, people that are new workers, meaning millennials, okay, that are being born during this period of time. All right. They're feeling this setback. Most other people, boomers, Gen X, you're not feeling this setback because for the most part, you already had a job. You had some level of security. You had some savings. You had some investment, right? This is the beginning of why millennials can't stand this economy, okay? Then you'll see in 08 and 09, this is why Gen Z can't stand this economy. This is also why you're hearing more and more calls for socialism and Marxism on a scale that we haven't heard in a long time. Actually, since back in 1929, when there were tons of calls for socialism and Marxism, and that's how we got socialism in the form of Social Security and Medicare and Medicaid and the like. But that being said, this growth trajectory was basically reset in 2000 and 2001 because the system became more reliant on inefficient processes. And those inefficient processes are government and the Federal Reserve, okay? It also became more centralized in terms of their control over the trajectory of the economy. You also have other factors such as economic growth and contraction cycles or consolidation cycles that have happened, as well as globalization is also impacting this entire picture. If you notice, we weren't able to make up the stagger, even though globalization should have been a positive if we could take advantage of it. Government and the Federal Reserve made it so that the US economy wasn't able to fully take advantage of globalization. Okay. And yes, you can take advantage of globalization. It means less manufacturing jobs, but it also means you have the ability to innovate and do other things that we haven't been able to do. Okay. But again, that's a topic for another day. Now we fast forward to 2008. Okay. We have the great financial crisis, which a lot of people have argued is just a perpetuation of the same things that we had going on in 2000 and 2001. Because if you remember, 2000, 2001 was leveraged bets on bullshit investments. Okay. .com companies that just had a bunch of clicks on their homepage. They didn't have anything other than that. All right. Same thing. Now you have leveraged bets on bullshit mortgages of people who shouldn't have been given a mortgage on a home they couldn't afford in the first place, couldn't even make the first payment. Okay. Same thing happens in '08, just to a much greater extent. Also, why? Because you have the introduction of moral hazard. Anyone who's unfamiliar with moral hazard, in 2000, 2001, as soon as the federal government and the FDIC and Federal Reserve and US Treasury steps in and starts, quote unquote, saving things, okay, and bailouts and all this other stuff, you introduce an element where failure isn't punished to the same level. And I'm not talking about like physical punishment or even imprisonment, despite the fact that a lot of people should have gone to prison in all of these different situations. Okay. What I'm talking about is the actual economic consequences of what was supposed to happen. In 2000 and 2001, a lot more companies should have gone out of business. They didn't. Okay. In 2008 and 2009, a lot more companies should have gone out of business, but they didn't. You have moral hazard from the standpoint that all of this risk taking that happened in the lead up to '01 and '02, and all of the risk taking that happened in the lead up to '07, '08, and '09 wasn't amply punished after the fact when the actual fruits of those ridiculous bets were supposed to come due, right? Those bills never came due. The American taxpayer subsidized risky behavior. So what do you get? More risky behavior. You also get a disincentivized environment where less risky behavior in boring stuff, right? Like industrials and agriculture and utilities being built out and made more efficient. All of these things are disincentivized because the return isn't that great. So why would you look to get a 5 or an 8% return on, building out and revolutionizing your utility base when you could, bet on the next cloud computing company and make hundreds of percent? And oh, well, if you got the bet wrong, the government will come in and fix it and make everything better, right? You'd be an idiot. The incentive structure has gradually been destroyed in what used to be a somewhat functioning marketplace. Okay. And again, you're talking to someone who loves Austrian economics. The functioning of the marketplace has been gradually destroyed ever since the beginning of the 1900s. Okay. But this thing is on steroids now. What people don't understand is they think we're headed into hyperinflation. We're not there yet. Shit's got to fall apart first. Okay. And it's going to. All right. But again, you see another growth trajectory deviation. Okay. So now after 2008, from 2008 to roughly 2014, 2015, you have another growth trajectory. Okay. Again, lower than the earlier decades, but still a growth trajectory. So what happens? Starting in 2015, give or take, the Federal Reserve and the federal government start kind of like pulling back on the support a little bit within the economy. And guess what? The economy can't function at the same level without it. Okay. It's why I call these interventions like basically cocaine. Okay. You have a functional cocaine addict that now you're taking the cocaine away. Well, it's not working like it used to. Right. Now, all of a sudden, we have 2019, 2020, which, by the way, look at this. You have this deviation. And again, I did an episode on this with my tinfoil hat on. You have this deviation starting in 2015 leading up to 2019. Okay. The economy was beginning to get sluggish again. Then all of a sudden, we have a COVID crisis. They ramp up all of these interventions, right? You have a quick dip, and then we have a pump back up in terms of gross domestic product. Now, understand this. This is not real gross domestic product. This isn't adjusted for inflation. Okay. This is just the absolute number. So the number actually isn't even this good. Okay. But that being said, you have somewhat of a quote unquote recovery. Well, if you notice, the recovery never gets us back to the growth path that ended in 2015. At best, it gets us back to the growth path that we had leading into 2018 and 2019. All right. But just to get back to that level, we've had to increase the debt by, trillions upon trillions of dollars. We've had to print tons of money to warehouse at certain companies so that they don't go bankrupt. Okay. The overall money supply is contracting because, and I'll show you why, the money supply is contracting because there is this giant black hole sucking sound of dollars out of the system. Okay. But it's not all the dollars. It's the dollars that are in circulation that it's really sucking out of the system. It's why the danger right now is deflation. It's not inflation. All right. Again, deflation and inflation aren't these like just kind of, I mean, they're basic concepts to understand, but how it actually plays out is a lot more complicated than most folks that like to put out slogans would have you believe. Okay. We've never really gotten back to this growth path. And this is, after extraordinary interventions on the part of, uh, on the part of, the federal government and the Federal Reserve. Okay. So these interventions have been uh, essentially unparalleled in human history, right? And we still can't get back to that growth path. That's why this quote unquote recovery is bullshit. Okay. I don't have it here, but if you look at the labor numbers, they would have you believe that we're in this great employment cycle right now, right? Like, oh, record low unemployment or record low unemployment, right? Record employment levels, right? But it's bullshit because it's relative to the participation rate. The participation rate has been that gap between the eligible workers or who could be an eligible worker and who's actually trying to work in the economy is growing over time. More and more people are becoming disenfranchised. And the whole time they're peeing in the air and telling you it's raining like it's some amazing thing. Like this is an amazing economy. It's not. It's a freaking house of cards that's about to fall. All right. Why is that? Well, if we look here, I actually won't even talk about transfer payments because that's a whole other story. But if we look at consumer spending, they want to tell you, so we're a consumer driven economy. Okay. We're based off of, buying goods and services, right? That's basically what we're built on. Well, they'll tell you, oh, we had this nice little trajectory on consumer spending, right? And if you notice, the trajectory on consumer spending has now fallen off. It fell off in 2008. It fell off in 2020. And now they're saying, oh, we're rebounding in consumer spending. Okay. Life is getting better. We're in a quote unquote recovery phase. All right. Well, actually, that's not true because if you look at personal spending here on the part of the consumer, and here I have to readjust this monetary scale here on the index on the right hand side. If you look at personal spending from like individuals, okay, so me, you, your grandma, all right, with the exception of a couple of big spikes, which by the way, this shows you why we're in this, supposedly inflationary environment in terms of pricing. This is literally the bullwhip effect in terms of the distribution system of goods and services within the economy, not just the US economy, the global economy. Okay. You see a huge dip in consumer spending, technically personal spending, a huge rise afterward because you still have this pent up demand, right? But notice how the amplitude decreases each time you have this back and forth. Huge amplitude, then you have a smaller amplitude pop and drop, then an even smaller amplitude pop and drop. This is the bullwhip in effect. This is prices and the supply chain working out the problem. Now, meanwhile, the Federal Reserve and the US government are mucking around in the system. And so this is behaving somewhat rationally. All right. But if you notice, we've just basically gotten back to whatever the normal trend was of personal spending. And again, this isn't inflation adjusted. So if you noticed everywhere, probably in your own personal spending habits, you're cutting certain expenses, right? Like you're cutting certain expenditures, but you're still probably spending the same total amount of money because some things are more expensive. Okay. Your rent, your utility bills, things that are slower to react in this bullwhip effect, okay, are still expensive. And basically, inflation, quote unquote inflation right now, it's all just a couple of things: financial products and housing expense. That's all it is. Oil has begun crashing, and it's because there's not a lot of growth in the economy. There's not growth in demand. There's basically just more expensive shit, and people have to buy less of it, but it makes the numbers look better because the absolute number still goes up because there's still problems in terms of the supply and demand dynamic. But so personal spending isn't going up appreciably. There's not some huge recovery. If you look back in the past, like look here in 2000, 2001, you had a huge dip and then it recovered back to the same level. Okay. If we look back further, like even throughout like the 60s, 70s, 80s, personal spending, like it might have a higher amplitude, but it pretty much settles somewhere around like, 0.8% per quarter, which if you expand that out to a full year, it basically becomes, 3%, 3.5%. And then if you assume 2% inflation or debasement of the currency, then you have a modest amount of real growth in terms of consumer spending in the economy. But if you notice, there hasn't been some kind of huge rebound. It's just kind of come back to where it was before. And that basically means that there's less stuff being purchased because of the pricing dynamic. Well, guess what? This is government spending. And if you notice something, if we go back, let's look at the start of it in 1995 leading up to 2000. In fact, I can just do it from 2000. Okay. You have this trajectory of government spending that ends up just getting annihilated in 2010. And the reason being is because when this gets annihilated in 2010, it's because essentially the ability for the US government to borrow was dramatically negatively impacted by what happened in '08 and '09. Because if you think about it, government spending from a deficit standpoint, it's not inflationary. It's a transfer of assets. And some of it's a transfer of assets in terms of present day assets, and some of it's a transfer of future assets into the current day. Okay. And so those assets have to be easily accessed, so to speak. And if they're not easily accessible because the world goes to shit, okay, government spending has to take a back seat. And so that's essentially what happened is government spending falls off between 2010 and 2014. And guess what? As soon as we start to see that waver in terms of the GDP growth, what kicks in? More government spending to try and get us back on that path. But guess what? It hasn't been able to because government spending is one, inefficient, and two, it's technically not growth because any growth that government spending creates is because it's taking growth from the future. Now, if you notice, what happens here, and this is also very telling about what people do and don't understand about what happened during COVID. Okay. Everyone wants to think that government spending in like 2020 and 2021 like went off the charts. It didn't. It pretty much stayed the same for a while until 2022 hit. Interestingly enough, October of 2022. Okay. And all of a sudden, government spending just rips off the charts. Why is that? It's because the stock market started to get just shellacked during 2022. Right. And then all of a sudden, we get this nice rally starting in October of 2023 because all of this government spending kicked in. But again, it's not causing the GDP numbers to improve. It's just trying to like maintain what we have, which is a substandard version of what happened in the past. And if we go back, we can look, this government spending that started in 2022, has it really affected the GDP numbers like to some great extent? And actually, let me pull it up. Has it really affected the GDP numbers to some great extent? No, it's just kind of tried to keep us on this path. And so essentially, whatever we have right now is just screwing ourselves in the future. It's stealing demand from the future to pull it into the present, which, by the way, because of the way that interest rate works and the time value of money, pulling a dollar from the future into the present, you don't get a dollar in the present. You get 50 cents or 40 cents or 20 cents, depending on what that future ends up looking like. Okay. So people also need to understand that the reason government spending is going up is because there's demand for US treasuries because big money is running for safety. And if you have any question about that, just look at this article that came out. I believe it was Yahoo Finance that wrote this. So Yahoo Finance, I mean, technically it was a video from Yahoo Finance, but it's the article that also talks about what they were talking about. And it says, for finance titans, the U.S. economy rules. Okay. And they talk about basically this group of, how should I call it? Robber barons, basically, that meet via the Milken Institute conference in Beverly Hills, of all places, it doesn't happen in like, Paducah, Kentucky. Okay. It's happening in freaking Beverly Hills, probably right next to Rodeo Drive. All right. And they come down here and they basically say that money gurus with investments all around the world report that the United States continues to attract far more quote unquote smart money than any place else. The person that they're interviewing noted that before COVID, about 18% of global financial flows went to the United States. Now it's nearly double at 33%. Okay. Some foreign investors may be overdoing it, but they don't seem to care. Harvey Schwartz, CEO of Carlyle, says the vast majority of investors, when I ask about the US, they say, I'm over allocated to the US, but I'm going to allocate more to the US. It's not an exotic answer to the US phenomenon. There's incredibly strong, quote unquote, earnings growth. Interest rates are high and economic activity underpinning all this is quite profound. Okay. The economic activity is all smoke and mirrors. The reason why this money is being attracted to the United States is because it's the last bastion of being able to borrow what is perceived as unlimited amounts of money. Okay? Let me let that sink in. Okay? It is the last bastion of places that have essentially unlimited borrowing capacity, or at least the perception of unlimited borrowing capacity. So what they're saying is the rest of the world sucks compared to the United States because we can reach further and further and further out into the future to grab demand, okay? Which, by the way, we're also sucking demand from the rest of the world as well. Because if you remember, the world economy, at least westernized economies, run on US debt. Okay. It is the collateral of choice. It's either dollars or US debt. And in most cases, it's US treasuries. Okay. And so that's why we're attracting so much money, is because basically we can continue to borrow supposedly recklessly. Okay. And continue to maintain some kind of smoke and mirrors idea of what good GDP and good economic activity is. When truthfully, 70-80% of the population thinks this economy is complete trash. It's not working for them. There was also a story yesterday that I saw, and I should have pulled it up on X, but it was a story that basically said that I guess the Border Patrol puts out monthly, like, quote unquote, encounters on the border. And their monthly encounters dropped by 40% month over month. And they're like, why is this? Okay. Why is it that all of a sudden we have 40% less encounters? Well, ask yourself this. If you were making that trek to come to the United States, okay, regardless of what you think the political end game is, the individuals themselves have certain goals that they're trying to achieve as people, okay, because they are people. And one of those goals is, economic prosperity, or at least better economic prosperity relative to where they live. Well, if 40% less people are coming across the border, what does that tell you about the perception of the economic prosperity that they can get by coming here and being, whether it be an under the table cash only laborer or a minimum wage worker, right? What does that tell you about what the environment is for the people that are in the lower bands of income? It means even though they might be able to make better money, and that's like a loaded phrase, but even though they might be able to make better money, okay, here in the United States, the pricing and the economic environment make it such that it's not as attractive anymore. The cure for things, see, this is also the other issue that is very tough to really kind of impart on people that like aren't economics people. Okay. Typically, these kinds of changes, if they're allowed to run their course without intervention, fix a lot of the problems that we continue to have today. Okay. If say like people that are like pro capitalism, okay, if we actually had capitalism, there wouldn't be as many calls for communism and socialism in the United States. And yeah, I get it. The people that are on the socialist communist side say that that's exactly what happens with capitalism. You have consolidation and all this other stuff, but that's not true. In actual capitalism, you let people fail. This environment, these charts show you that the federal government, based off of their partnership, their managerial class partnership with the rich and wealthy influential people in the country, have stopped certain classes of people from being able to fail. That ruins the economy, and that doesn't allow economics to actually do what it does. A long time ago, the migrant crisis would have been solved because we would have gone through a long, protracted recession. And during long, protracted recessions, people don't show up. There's no money. There's no jobs. There's contraction. Okay? The upward mobility perception of what it is to be in the United States decreases. Well, guess what? It's starting now. The migrant crisis will solve itself if economics is actually allowed to take root in the United States again. It won't, though, because the path that we're on right now is knowingly unsustainable. And yet at the same time, no one who's in a position of influence or power wants to be, one, truthful with the people that are supposedly their constituency, and two, they don't want to be the one who goes down in history as who allowed the bubble to burst, right? They've got all of these balls that they're juggling in the air. They don't want to be the one who drops them all. So they'd rather just add more balls and then pass it off to the next schlub. All right. Technically, the next corrupt tyrant that comes into play and adds even more balls. And that's the dynamic that we have working right now. This whole, great economy that we have is all just borrowed deficit spending. And it is so inefficient because if you look at the GDP numbers, it comes out to something like a 3 or 4x. The reason why I say you pull a dollar from the future into the present, and maybe it's only worth like 20 cents or 25 cents, because that's exactly what we're getting right now. We borrow 10 trillion and we get like 2.5 trillion in GDP activity, right? Like, one, that's not sustainable. And two, who the hell are you talking to that's actually believing that this is like a good economy? It's not. Recession is coming. It's inevitable. Okay? And the further that the government tries to kick this can down the road, the worse that recession gets. And this is a different world than 1929. Okay? In 1929, the government had less of a role in the actual economy and the functioning of markets and things like that. And so once 1929 hit, again, I mean, I could, if this chart went all the way back to 1929, I could show you that as well, right? But what happens with these things is typically as the government steps in more and more, those inefficiencies grow, but also the government then is forced to step in more and more in future crises, okay? Because those crises never were allowed to get down to, like I keep coming back to the volcano example. The volcano has to erupt and it has to destroy a lot of stuff so that new life can be breathed into the economy, right? There are tons of companies right now that are just bad companies. They're not good, okay? They're many of them are like standalone companies. I saw something today about like some hostile takeover at Peloton. So Peloton jumped like 15% or whatever. Dude, Peloton is not it shouldn't be open anymore. It was a one-trick pony. Peloton should have been a company that licensed its technology to someone else and allowed them to produce it, right? Like would have been if they like teamed up with like Sony or Samsung or something like that. Okay. And they had some great partnership going on there. That would have actually been a more efficient use. But because money and specifically debt was so plentiful, Peloton decided, oh, yeah, we can be $1 billion company selling, selling exercise bikes with LCD TVs on it, which, by the way, you can get just with a cheap LCD and a roll of duct tape and YouTube. But I mean, right. But that's like the poster child in my mind. There's also a number of companies like GameStop, like AMC, like all these kind of like meme stocks They should be out of business. They should be gone. They should be a side note in history. But because of the moral hazard that exists within the system, it won't be allowed to happen, which then perpetuates more moral hazard. It perpetuates more risk taking. And unfortunately, that also means that, I'm sorry, if you're like a Bitcoin maxi, all right, you don't understand that if you have 100% of your assets in something like Bitcoin, I mean, you think you're going to become, I've noticed this a lot. People specifically within Bitcoin space, in the Bitcoin space, not necessarily just the crypto space in general, but within the Bitcoin like maximalist kind of space. Okay, if they're all in, the reason why they're all in is this creeping level of like Schadenfreude. Okay. And if you're not familiar with the concept of Schadenfreude, it's when take pleasure in seeing the debutante, the prom queen, the popular kid in school fall from grace, trip and fall and be made fun of and laughed at, or have something tragic that happens to them that now takes them down a peg or two. There's this Schadenfreude or this desire for Schadenfreude that exists within that space. And unfortunately, it's blinding people and making them take on way more risk than they need to be taking on. The risk management process is broken because people are buying into stocks like Nvidia. They're buying into meme coins and meme stocks and just some ridiculous investments. At the same time, all of those rich people in Beverly Hills, okay, they take their billions, they buy US treasuries, they earn their 4.9%, federally tax protected yield, and they're happy with that because they know this is a freaking house of cards. They'll buy their lottery tickets. They'll have a small piece of this or a small piece of that. They probably have a small bit of Bitcoin just in case like the mania keeps going. But really, in reality, they're holding cash, US treasuries, gold and silver, real estate, their own businesses that can actually scale. Those are true investments, right? But the risk-taking behavior of people, specifically people who can't afford to lose, right? Like those wealthy people, if they put $10 million into Bitcoin and it goes to zero, they don't give a shit. It's pocket money to them. They don't care. The people that run the BlackRock ETF, if it goes to zero, okay, that means nothing. It's a rounding error. They write it off on their tax statement. It actually probably helps them. But for the average Joe, the plumber, the carpenter, right? Like the person who works in IT who thinks they have it all figured out, when they, make 80 grand a year and they have an investment portfolio of 100 grand and it's all in Bitcoin, when that goes to zero, dude, that person hurts. And unfortunately, they feel like they have to take that risk. Whether it's because they want to see the debutante fall and the billionaires become poor and they become rich, okay? Or just out of desperation, right? Their 80K hasn't every single year hasn't gone up enough to keep up with all of these, broken market mechanics that are happening right now. And because the jobs market right now is the way that it is, I wrote an article yesterday that basically said, don't leave your job. Okay. You also have to be careful just because you have another job offer. In this environment, a lot of companies will extend job offers. And then all of a sudden tomorrow you leave your current job and the new company's like, yeah, about that. Sorry. We thought we had more money than we did. Or that project got scuttled. And so we can't hire you. Okay. The employment dynamic is going to change dramatically, as well as this quote unquote inflation narrative. Okay. Inflation can become deflation very, very quickly, especially if all of the chips are stacked in the United States and all of the chips are stacked in the US government continuing to borrow demand from the future into the present to try and keep things afloat. At some point in time, there becomes no liquidity left in the system. And so US treasuries being issued essentially suck cash out of the system Okay. And then they redistribute that cash in other areas. But again, it's inefficient. It's slow. The US government borrowed all of that money and it took them 2 years to start spending it because everyone's got to get in line and all the lobbyists have to have their lunches and they all have to write bills that then involve the spending and all this other stuff. Okay. It's an inefficient process, which means when they suck liquidity out of the system, they're not giving back the same amount. I could do the same thing with pulling up the velocity of money. The velocity of money continues to drop and drop and drop. And the reason why it continues to drop is because more and more economic activity is dependent upon government intervention, whether it be government spending, government regulation, et cetera, et cetera, et cetera. And because that those inefficiencies grow, how quickly money can exchange hands drops, no matter how much of it you print. And so from this standpoint right now, what we're looking at is there's a big recession coming, okay? And the people that are banking on, the US stock, I wrote an article the other day too, uh, and if you're not subbed, again, I'm giving away 4 free annual subscriptions to the Anarchist Investor, anarchistinvestor.substack.com. I wrote an article last week about the case for cash. And yes, in the near term, there's a case for cash. And yes, I know over a long enough time frame, it's going to zero. But tomorrow and the next week and the week after that, if shit actually comes back to reality and this economy actually reflects what reality is, cash is going to be king, at least for a short period of time. Because believe it or not, as much as you think that that cash is out there circulating and causing inflation, it's not. It's actually going in the opposite direction. It's being warehoused, okay, in the bank accounts of rich assholes and tyrants and bankers. Okay. It's being warehoused at corporations to try and, be able to survive what's happening or what's going to happen. We could be in a recession right now. The numbers do not reflect reality. And so the truth of it is we could be in a recession right now. The ISM non-manufacturing, and this is getting super economics nerdy. The ISM non-manufacturing index, purchasing managers index last week, okay? And again, remember services, which is non-manufacturing, is like 60-70% of the US economy. It's in contraction, not growth, not flatlining, contraction, which means a lot of people are trying to say stagflation. Stagflation is when GDP goes up, goes down, but doesn't really make any moves, right? Like on net, it just kind of stays flattish, maybe even slightly down. Okay. We're headed into recession. And if people aren't careful, depression. And so that's something to understand. And risky assets are not where you want to be. You don't want to be in risky assets. That includes Bitcoin. That includes having a large amount of your portfolio in crypto. Crypto has a future. It will be and will continue to be a great investment, like speculative investment area. Okay. But you might not reap those rewards for 10 or 20 years because build out has to happen. The volcano has to erupt. Things have to get destroyed before new growth happens. Okay. A lot of these projects that can't stand on their own 2 feet are dependent upon hedge funds and private equity funds and all of this loose money in the system. Okay. They're going to fail because if they can't stand on their own 2 legs, they're not going to be able to borrow in the future. It's just not going to happen. And so there has to be destruction. The things that typically don't get destroyed, at least in a short period of time, are the lifeboats. If I pull up fixed income today, the casino's up, okay? And in fact, it was up more before, I think. But the casino continues to be up because the Federal Reserve essentially pivoted on Wednesday last week. They began their easing cycle when they essentially committed to stepping back up to the plate and buying more US treasuries. And the reason why they have to is because there's not enough cash left in the system for non government and Federal Reserve entities to soak up all of the US treasuries that have to get issued in order to keep the party going. And so the Federal Reserve has to now step up and start essentially the Ponzi scheme has to ramp back up again. And they're not technically in quantitative easing because they're still allowing their balance sheet to trail off a little bit, but they identified that there isn't enough demand. There's tails happening on these US Treasury auctions, which means a lot of people that normally would be buying US Treasuries at a certain interest rate, they're not buying at their interest rate. They want a higher interest rate. Why? Because there's more inherent risk in the system. Look at this. If you look on the right side of the screen, from the 2-year all the way to the 30-year, people are buying US Treasuries. The rates are going down. It's not because the economy is growing. It's because people are running for lifeboats. The smart money is running for lifeboats right now. HYG, right? High yield bonds. This is our indicator for longer term risk taking. Okay. This is a leading indicator. Yeah, it bounced because we think that the US government is coming back to the plate to help us out. But it's not bouncing considerably, and it's coming back up to basically a resistance line that it'll eventually roll over and fall off. Because a lot of these companies deserve to go out of business. They're not good companies. These are high yield for a reason. Their debt is risky. But in the meantime, we're bouncing because, yay, the Federal Reserve is coming back to ride in on its white horse and help everyone. But you got to remember, they're always late. They're always late. As much as they think they're brilliant and intelligent and they know all the numbers and they can fix everything, they're wrong. And on top of that, they don't let the economy do what it needs to do. Look at oil. It's caught a little bit of a bid today. All right. This is on a 3-month basis. But if you look at the daily, dude, this thing's getting stomped. And in fact, it looked like it was going to go to the moon, but it's since reversed course. A lot of people might say, oh, inflation is coming down. No, demand is dropping. And there's too much supply. That's not the hallmark of a good economy. And in fact, if oil continues to fall over the next couple of months, that's a really bad sign because we're coming into summer. Summer's typically high driving season. You should see a decent bid for oil and gas and energy. People have to run their air conditioning, right? But it's not playing out that way. Not yet anyway. Could change tomorrow. But from where I sit right now, this is a huge downward correction in oil. If it continues, it's reflective of a really crappy economy. You know, what's funny is Trump actually gave an interview the other day, and he said he's worried that he'll get elected and the economy will fall apart like the first day he's in office. Okay? It might fall apart before then. Economics is undefeated. You could try and kick the can down the road as much as you want, but eventually, the pain has to be paid for in some way, shape, or form. Eventually, average everyday people will begin to realize that. The problem is how they decide to fix things. I mean, you're already seeing it. They're calling for more socialism and more Marxism. Unfortunately, that's not the answer. But again, I don't go on too many like political rants, but unfortunately, when you're talking about government spending, they're like intertwined. These things cause aberrations within the market and not just small little pinpoint aberrations. As I just showed you, growth line, reset, growth line, reset, growth line, reset. Okay. Until eventually we don't get any recovery. And in fact, based off of what kind of like baseline you use, looking at the current quote unquote recovery from COVID, a lot of metrics show that there's been no recovery. It's just things fell off. We corrected a little bit and then we've just flatlined. Okay. Other things have continued to fall off. Shit, look at lumber, man. Dude, look at this. Bro, lumber is destroyed. This ain't inflation. This isn't economic growth. This is destruction of demand. It's destruction of value. Try and buy a house. Houses aren't getting constructed fast enough. People aren't selling their house that's already an existing structure. Okay. There's just no demand for lumber. This isn't economic growth. This is recession. The ISM last week showed you we're in recession. Problem is, it typically takes 6 months for the powers that be to actually concede that we're in a recession. All right, last, let me close with gold and silver because I can't not talk about gold and silver. Gold and silver right now aren't catching the same bid that, say, like, the dollar's holding up all right now. Okay, U.S. Treasuries are being purchased, but again, gold and silver made their big run up here, and they've pulled back ever since they kind of hit. Well, at least gold hit the all-time high. And part of that just has to do with the normal ebb and flow of this market. Okay. There was a lot of profit made. So the people that are the big holders of gold and silver, even the central banks, they may have even liquidated a little bit up here to realize the profit and redistribute that money into either US treasuries or into dollars. All right. Like I said, they're not buying commodities, right? Like this commodities index right here, the DBC, they bought them a couple of months ago when the government was going crazy with spending. Okay. But they're not now. Right. Probably the only thing propping up oil right now is because the White House has to refill the Strategic Petroleum Reserve. It's created a put on oil, and yet it's still falling. But commodities aren't like ripping to the moon. Okay. This move here is just a correction off of an oversold condition. We'll see what this is made of, in the future, but this looks like it's just keeping with this downtrend. This is not an uptrend in commodities prices. People calling for stagflation, I don't think they're still snake bit from what happened in 2021 and 2022. Okay. And now everything that they see is stagflation, or at least has some element of inflation in it. We're going the opposite direction. All right. That's all I got. Very somber episode today. There are a bunch of you watching on X. I can see that you're watching on X. I appreciate you watching on X. Do me a favor. If you're not following me, please follow on X. And if you watch video content or audio content anywhere else, go to your favorite podcatcher or go to your favorite video platform and look up the Anarchist Investor and throw me a sub. So with that, that's the end of the program. I wish I had better news for you, but the good news is that we're all here and we can learn and we can keep working towards protecting ourselves a little bit. And you should definitely read some articles that I'm putting out too, because there's definitely some things that you can do to immunize yourself against the coming recession and possibly depression that's coming up here. So with that, I will be back tomorrow. Hopefully I have better news for you tomorrow, but I will be back tomorrow at 12 Eastern. And with that, I want to say thank you all for your attention and your time and your energy today, as well as every day. And I look forward to talking at you again tomorrow. So with that, have a fantastic afternoon. Peace. Stuck in a system that just ain't right. Gonna tear it down. Gonna start a fight.